So my goal for the year is 100% return. Of course, it's a very big goal for options trading. I'm hoping I can get there.
Many options traders like to be market neutral and primarily make the money from time decay. But there is a catch. Often these trades get into trouble if the market makes a big move up or down, or if there is a spike in volatility. My guest thinks he has found a way around these problems with great success. This year he's up more than 40% in less than 4 months. From New Zealand, welcome Simon Black.
Hey John, how's it going?
Great. And give me a high-level pitch of what this strategy of yours is all about.
So this strategy is my attempt, like you said in your introduction, to try to make the most of theta decay while staying delta neutral, like a lot of traders like to do, but at the same time, hopefully manage volatility, contraction, and expansion. And trying to cover all our bases with the market moves. And these trades I try to do are weekly trades, so I'm trying to make sure that I can have a trade that can survive the week. It's pretty much the go-to for me, and along the way the theta decay kicks in and hopefully we make a nice little profit.
And we will really dig into the details of how you set up this trade. But first, tell me a little bit about yourself as an options trader and person. You live in New Zealand, as far as I understand.
That's right, I am in New Zealand. You probably can tell by my accent. People might think I'm from Australia, or some people think England, who aren't good at accents. But yes, I live in New Zealand. I live in the capital city, which is called Wellington. I was born and raised in New Zealand. I've been an options trader. I think I started around 2007. I've got an engineering background, so I've always liked numbers, and I just sort of gravitated towards options trading. I dabbled in futures trading for a while, but the time zone difference meant that it was not good. I was getting up very early in the morning, and options trading suited me a bit better because obviously you can put options trades on that last many days, weeks, and you don't need to be at your computer in the middle of the night, my time.
But how is this with the time difference? Because you have a huge time difference to the US market.
That's right. So the market opens, depending on the time of the year, both USA and New Zealand have daylight savings. So there's a 2-hour drift throughout, depending on what time of the year you are in. But the market opens sometime between either 1:30 a.m. or 3:30 a.m. my time, which means it closes between 8 a.m. and 10 a.m. my time. At the moment, because of the daylight saving, it's back to 8 a.m. So if you don't mind getting out of bed before 7 o'clock in the morning, which isn't too hard for most people, I get a good at least hour looking at the market, or 2 hours if it's up earlier. And then in our summertime, it's 10 a.m. finish, so I got plenty of time. I almost have half the market to half the day to look at. So in terms of options trading, it's more than enough time.
So let's move to the specific trade we will talk about today. You call this time flies spread. This is a weekly strategy. What are you trying to achieve?
So I'm trying to get into a trade which is delta neutral. So anyone who trades things like iron condors knows the idea that you want the market to not move too much. And I'm looking for basically to make the profit from the theta decay. The trade itself is a combination of a couple of trades. I saw a similar trade to this by a guy called Dan Sheridan. You might have heard of Dan. He's got a YouTube channel. He had a similar trade, but a little bit different, and it gave me some ideas. And it's a while ago now, and I started playing it for myself. So trying to be delta neutral, theta positive, vega positive. I called it a time flies spread, bit of a play on words there, because obviously theta decay is all about time flying by, but also there's a sort of a calendar diagonal component, which is a time sort of trade, and there's also a butterfly component, which is a fly. So time flies. I thought time flies spread's a nice catchy name for this trade.
And we will try to make this step by step, but just explain for us the basic setup of the trade, which I understand is composed of 2 different trades combined.
That's right. So best way to think of the trade for anyone who's done these kind of trades before, I'm trying to combine a put diagonal below the market price and a call broken wing butterfly above the price. So you sort of have to understand diagonals or calendars, which are very similar trades, and butterflies. And that's the two components to understand.
So let's actually explain these two trades separately first, and then we will go into what happens when we combine them. So let's demonstrate what is a diagonal, a put diagonal first.
So you can see here what I've done. This is just option strat, and this is the Russell. What I've started with is what we call a calendar. So a calendar is a trade where you have two legs. You buy a leg and you sell a leg. So this one here is short, this one here is long, but notice there's a time difference. This one here is the 1st of May, this one here is the 5th of May. So that's a classic calendar. To make a calendar a diagonal, all you do is also change the strike. So not only is the option you're buying a different expiration, it's also a different strike. So to turn this calendar into a diagonal, it would be as simple as just dragging this along. So these are all diagonal trades. So the way to tell a diagonal, I think it's quite a clever name, a diagonal, because it's not only it's different, it's almost different in two directions. It's different in time and different in strike. So this on the screen here would be a put diagonal.
And how would this one look at expiration? This is not yet the expiration.
Right, that's right. So you can sort of see here, let's just see at the moment here, this peak is what, 3% below. Let's make it a 5 wide diagonal. So you can see here, the line's quite flat. If I move the date along, that line pulls up towards that point. And of course, at expiration, if you think about expiration, if you're exactly at that point at expiration, because the option you're selling expires first, at the point of expiration of the short option, you would still own this long option. And of course, if the market had dropped down 3% or whatever, this long that you bought would have increased in price, whereas the one that you sold, it would have gone down to zero, of course, if you're exactly on the price, right? If you're slightly above or below, of course, it's not quite true. And of course, this is a theoretical return. You would never get exactly to this point. Although I guess you could have, at the price ended exactly on 1900. Being the Russell, it expires to cash, so you could. But the problem is you never really let calendars and diagonals expire because you want to get out of the long leg too. You don't need to, but if you want to get out of the trade as a whole, you usually close this before expiration. So really, like I like to do with these kind of trades is drag the date back to maybe the day before or something. 24 hours is a good time because I think that's a good way to get a good idea. So here's 24 hours before expiry. You can see it's a nice, this pulls up nicely. So if I thought the market was going to pull back 3% during the week for whatever reason, a diagonal is kind of nice, or a calendar or a diagonal is quite a nice trade to play that kind of play.
And this trade you place below the market is what you
Yes, below the market. And one thing I'll show is how volatility acts on this trade. So as we know, volatility and market drops sort of go hand in hand, right? When some big news is announced and the market dumps 5%, vol spikes. You hardly ever see the market dump and the vol go down, right? It's sort of that correlation, right? The markets don't crash up, right? They crash down. So what would happen if the market did make a big 3% move, which in today's political climate, 3% move seems like an average move, but normally a big 3% move is a bit more unusual. What happens is volatility spikes. So what you'll see, if I start sliding the vol slider up, you'll see that the overall temp gets wider, right? So it's almost like this buffer where you're playing for a downsized move, but when you get a downsized move, the tent gets wider. So even if it moves further than you thought, it's it's compensating for that. So go to show that again. Here's vol as it is today. Let's say the market really did start dumping down minus 5% here. I'm getting close to where I might break even, but if the market dumped 5%, vol is not going to sit still. Vol is going to go up. So if I slide the volatility, say plus 5%, 6%, which is, I mean, last few weeks, we've had plus 10, plus 20% vol spikes, even more. So it sort of shows you these calendars and diagonals have a downside buffer that manage to work well with volatility. Hopefully that makes sense.
And let us then move to the next trade that you put on the other end of the market, and that is a call broken wing butterfly.
Okay, so this is the other side of the market. And I think the previous example, I put the short about 3% below the market price. I put this one about 3% above. This, what I'm showing you, is just a regular butterfly. So again, I'll drag the date timer along. What a butterfly looks like is this kind of trade. You short a couple of call options and then long one either side. And a regular butterfly, I'll put it to the end so you can see the extreme. You can see here I've got a, what is this, a 15-point gap between the two legs. So this is just a regular balanced butterfly. And to make a broken wing butterfly, I think the name comes from the fact you kind of break one of the wings, which is to basically move another wing away. So the classic way of doing it is to make, in this case, for a call butterfly, you'd make the higher strike further away. So I can make it, say, move that one more away, or two more away. This is the broken wing butterfly. You can either move the longer one leg away or the lower leg closer. You get the same result, right? So what you'll start to see is, rather than there being an equal loss on either side of the butterfly, you'd see more loss to the upside. So to put it back kind of where I had it, let's just say 15 and 20, should be about here. So this is the butterfly. And again, let's just go back 24 hours because, again, you can hold this butterfly to expiration, but let's say you want to get out 24 hours before because that's your thing. You can see it's actually quite flat. It's not quite as pronounced as the calendar. You don't get that really big spike. But again, this is where I like to talk about volatility. Now, of course, if you're in a butterfly, if the market starts crashing to the downside, of course, this loss area at the top here is not going to be in play because the market has gone down. But if the market starts, I don't want to say crashing up, but starts flying up, what's going to happen again is normally when the market starts going up, it's the opposite of our last example. Volatility starts decreasing. It's like things are good. And what if I start playing with the volatility slider with a butterfly, what you'll see is again, it starts dragging up. It's exactly what you saw on the calendar, right? The break even doesn't quite come in, but the actual profit starts going up. And this was what fascinated me about this trade, is that I've got a trade on either side of the market where if market starts dropping and vol increases, it kind of handles it. And on the positive side, if the market starts going up and volatility starts contracting slightly, it gives it a bit of a boost as well. So this is what seeded the idea for this kind of trade.
And I think if anyone thinks it's a bit difficult to follow all the details here, we will provide them in the article that accompanies this video. But let's see now what happens when we combine the two of them.
Okay, so what I've done is I've created the trade. This time I've used SPX mainly because we're recording this outside market hours and the Russell prices aren't correct and it just doesn't look right. So I've just moved to SPX, but it's a similar thing. Anyway, so you see here we still have this diagonal. You can see different expiry dates, different strikes, which makes this diagonal bit here. And here's broken wing butterfly. You can see the widths here are 30, 40. And the exact widths on both sides, that's where a bit of finesse comes in and a bit of sort of playing an option strat to get the curve. But now we've got the whole thing together, I can sort of show you. So like we said here, this is this date is the 2nd of May, which I believe is next Friday US time. So this will be a trade for the end of that week. And so we're down here on the 0 line here, 0 days. You can see here, if I start dragging time along, you'll just sort of see that curve just nicely starts to rise. And you can see if the price stays neutral or drifts slightly down or drifts slightly up, would be okay. Again, let's just move forward a little bit. Now, what happens if there's a bit of a sell-off? We start going down and vol starts spiking. You can sort of see, like we discussed, that tent to the lower side is sort of handled. We go back to reset the vol and say, what if the market starts drifting up and vol starts contracting? You'll see this will get close to the to a loss zone. But what, in my experience, is what happens is when the vol really starts dropping, it's because the market actually has gone up a decent amount. you hardly ever see the market stay still and vol just half or whatever. So vol starts dropping, and you'll start seeing, of course, a loss here, but we'll make the assumption this dotted line has moved up a bit. It starts pulling that tent along. So if we start moving forward, then you'd start pulling up into here. So that's sort of the gist of this trade. Yes, there is a loss zone if vol really does drop and you stay still. So that's probably the only, from my point of view, the biggest way this trade can lose, other than a 10% rip to the upside or the downside, is that if you literally stay still and vol just completely collapses. And in my experience, that often doesn't happen because, like I said, the contraction in vol is because normally the market started grinding up again and everyone's happy with the market. So put vol back to where it was. Yeah. So
because when do you close the trade? When do you take profit?
So I try to take profit. If my trade is showing a 10% profit on buying power. So you'll see here in this SPX example, this would have been a $500 debit. But of course, the buying power, because you've got a calendar, will be slightly more than that. One thing I like to do in option strat is you can see where it says max loss. If you slide the range chart to be massive, right, you can see this is where these max losses come in. If the market really dumped, this would be minus 1,200 to the side, or minus 1,500 if it really ripped up. So either buying power or max loss, usually they're about the same, but because there's two sides, my broker is Tasty, and Tasty sometimes shows different. So let's just say let's round it up. Let's just say the buying power was $1,500. Then I will be aiming for 10% of that, $150. So I don't care what the debit is that I paid. And if you look at my trading history, because of the way I play with the curve and option strike, sometimes and Russell could be a $200 debit, a $50 debit. I've experimented with these trades getting in for a credit, which you can do because of the nature of broken wing butterflies and a wider diagonal width. So the debit you pay or the credit you receive is not so important to me. It's the percentage of the buying power. So if sometimes I get into these trades, I usually get into these trades Thursday US time. So usually they're an 8-day trade. So in on a Thursday, the expiration is the following Friday. So that 8-day trade period. Often I've been out of trades as little as the next day. Something's happened and 10% profit shown. More often than not, you'll start to see that 10% profit on the following Monday or Tuesday. Sometimes you don't. Either way, I like to be out of the trade 24 hours before that expires, win, lose, or draw. I've been in trades before where I thought, if I just hold on and the market just moves 0.5% tomorrow, but the way that everyone knows, if I just bring this back a bit, when you start dragging these sliders to the very extreme, that's when you get the big movements, right? The real whip at the end. And so you could be sitting up here showing a profit with, what's this, 11 hours to go. You think, I'm just going to hold on. I hope it moves up. And the next minute, it's dropped. You've lost that profit. So I would rather be 24 hours before. I quite like this curve 24 hours before. I think it's it hasn't collapsed completely.
But this is when it's going the right way. But what about if it turning into loss? When do you close the trade, and how do you manage it if it goes against you?
So I have a few techniques for adjusting, and it does depend on market conditions. But one thing you can do, and it does depend on your personality and your mindset. Some people, the good thing about these trades is they're all defined risk trades. There's no undefined risk. You know your max loss the moment you start. So some people like to just take the loss because it's a max loss if you can get to a max loss. Max loss is very rare because you'd have to market would really have to move a lot in each direction. But you can take a loss. So that's one option, perfectly fine, take a loss. What I like to do is, say the market starts drifting up, and you say, well, no one knows where the market's going to go. You might say, there's no way this market can go up another more than 4 or 5%, whatever that is. You can start doing adjustment trades. In the past, I have bought a calendar above the butterfly. So I've sort of given it a little bit of a target to aim for. And I've also bought a calendar below the other diagonal as a way to buffer a loss. And in fact, one of the biggest profits this trade's made this year is when leading up to Trump's announcement of the tariffs, the Liberation Day, everything I read basically said it wasn't going to be good news. I was in a trade, it was somewhere near the 10th of the diagonal. So if nothing moved, it would have been a nice trade anyway. But I just knew there was bad news coming. So I literally just bought a calendar 5% below the market price, hope for the best. If nothing happened, I would have probably sold that calendar for a small loss. That was my insurance policy. But the price moved exactly into the calendar zone, saving the whole trade. So this is the base trade, and you can just use your trader skills and knowledge about different technique, options types to see if you want to adjust it. Well, you can just get out. It's all about level of experience. Obviously, I've been trading options a long time. But the good thing about tools like Option Strat is you can come along and go, what would happen if I just put a butterfly here or a calendar here, or just bought a put, bought a call, So there's a few ways you can adjust it. But
What's
I think
the max loss you are comfortable with when you take a loss?
I probably, let's see, I'd be comfortable with maybe minus 40, minus 50% loss. I hardly ever have lost that much, but I'd be comfortable with that, because what that means is if I'm saying getting a 10% profit over the weeks, to have a full max loss of say 50% or 40%, that's sort of wiping out 4 trades worth of profits. But of course, luckily for me, it hasn't happened that much recently. But I think something's going to happen one day. There's going to be World War III. I don't know. There's always going to be something that happens. So I'm fully prepared to take losses. But I think at the moment, I'm quite comfortable. And moving to Russell, I think I mentioned earlier, I only moved to the Russell because of the trading requirements for SPX. And it's actually been quite good for me. The Russell has lower liquidity. It's not as easy to get in and out of trades. But the Russell doesn't rip up as much as SPX. Like, when the market's going well and Tesla's booming and Facebook and Google and Apple, the market can just really start grinding up lots. You go and look at the Russell for the last 5 years, it's gone up, but it never has that real power. So I don't get a lot of the upside moves. And that's sort of the weakest side of this strategy, is the upside move. The downside moves are actually pretty good because of the nature of vol expansion and the butterfly. So moving to Russell's been really good for me, because we don't get those.
How do you enter and exit the trades? I guess you cannot do both the trades at the same time as one trade. You need to do it separately as two different trades.
So my daily routine, well, I guess weekly routine when I come into this, is I open up Option Strat and I play with the legs like you've been seeing me doing. I get the shape that I like. I play with the vol slider and I basically get the trades I want to do. And then this is just my preference, I always enter the diagonal first. Just go into Tasty, just a 2-leg order, put in the price and then play with the price till it gets filled. And then I go in and put the butterfly in separately. The buying power combined is about the same. So once you're in one, you don't need more buying power for the other. You can do it in either order. I've always done the puts first and now do the calls second. And when you want to unwind it, I guess it's the same way. You usually get out of one, then the other. Sometimes getting out of the butterfly can be a little bit not tricky to get filled, but sometimes I take off the 2 halves of the butterfly separately, because as you know, a butterfly is really just 2 vertical spreads stuck together. You've got 2 shorts and 2 longs. So you can get out of half the butterfly if you want, or not even get out of the whole butterfly. If you've got if the highest call is worthless, you could just buy back the shorts and leave that long.
But it does take some management and you need to pay some attention to this trade. It's not just place and forget type of trade, I guess.
That's right. Because of the nature of having a diagonal, there is some attention, because of the fact that if you left it to expiration, that's great, and all the calls and the short would expire, but you'd still hold that lower long put, which you might be happy with. If you think the market's going to keep going down, that put can keep making money. But if the market rips up and you didn't sell that long, you've now lost a bit of the overall diagonal profit. So definitely some management. I would look at this trade once a day. I wake up in the morning, I see what the market's done. I keep the trade saved in Option Strat, so I can just pull up Option Strat and just sort of see how it's looking. Of course, I look in my broker as well, but Option Strat's quite convenient just to see how the whole thing is moving. I'm not going to make more than probably one or two adjustments, not even probably even two, maybe one adjustment max. I'm not sitting there buying a calendar, then selling a calendar, then buying. It's not that kind of trade. It's like I will hold it and do nothing for days, and then if I think adjustments needed, I might do one, or I might not. But it's definitely not an actively. It's managed actively, but it's not like zero DTE where you're watching the screen and you need to really focus. So it's a check once a day kind of strategy, which I quite like.
If I ask you to place it on a risk scale from 1 being a very low risk and 10 being very high risk, where would you put your time fly spreads?
I think the nature of the width of the strikes, the range it's containing, makes it relatively low risk. And the fact that it's defined risk, obviously in general, automatically makes it low risk. The nature of having two trades combined that needs a bit of mental thought and understanding maybe increases the risk a bit, because I guess if you're new to options trading, you might make a mistake and not understand. So I'd probably put it right in the middle. I maybe a 4 or 5 out of 10 for risk.
So Simon, I mentioned a bit about your results, but please elaborate. What have been your results on this strategy so far?
So I started trading the strategy and keeping accurate records, I think September last year. And for 2024, I was trading nothing but SPX. And in that period, I got a 40% return, and that was great. And then like I mentioned, I moved to the Russell this year. So all my 2025 trades are in the Russell. And as of, I have them all recorded on a website if someone wants to see the results. But as of a few days ago, I think it's up about 45% for the year. That amount of money is based on me allotting $3,000 per contract. So you would have seen me playing with an option strat. A trade might have a buying power of $750, $800, maybe up to $1,000. But I'm not just saying I've got $1,000 in my account, I'm going to trade one. I want to have a bit of a buffer in case you have some losses. So assuming you put $3,000 aside to trade one of these, I'm up about 45% for the year. And I guess if you did the maths and annualized that out, that will be over 100%, aiming for over 100% return for the year. So my goal for the year is 100% return. Of course, it's a very big goal for options trading. I'm hoping I can get there. So we'll see. But so far, it's been really good. I'm doing a weekly trade. There were a couple of weeks when I was on vacation, I think in January, I didn't trade, or February, I can't remember. I didn't trade. So I think I've had 12 trades this year for 11 wins. So it's pretty good.
It's amazing results.
Yeah.
Simon, how would you sum up this strategy? And who is it best suited for, would you say?
I would sum it up as a way to be delta neutral and with good positive theta to try and get that time decay, hopefully with buffering built in for volatility. I think it suits any sort of, I don't want to say beginner trader because it's a bit to it, but any intermediate to advanced trader who likes to play with a trade where they get to experiment with things like calendars and butterflies where they wouldn't normally do it in a relatively safe manner. I think it suits a trader who doesn't necessarily want to be at their computer all day, because I'm asleep for half the market being open, so it works fine for me. And anyone who wants to trade a strategy which is define risk, so they know they're not going to wake up in the morning and they're underwater by 50K or whatever that can happen sometimes when you trade naked. So I think it's a good general strategy. I'm quite happy with it.
What would be good sources to learn more?
So I have a website. I started the website mainly because I thought this will be a cool trade to try to teach people. Full disclosure, I want to make a course. I haven't even started the course, but I have a website that lets people register interest if they want to. And also the site has all my results for last year and this year.
Would you have a couple of good options trading books to recommend to our viewers?
The one that I read the most recently, and it's probably is my favorite one, it is the Tasty Works one or Tasty Trade one. It was an unlucky guide to options investing or trading, whatever. I can't even remember the exact title. I think that book, Julia's book, I think that book was really good. I think it really breaks down sort of the Tasty methodology. I don't follow Tasty exactly, but I'm big on the way that they really put maths behind and numbers, and they really think about it. Because like I mentioned, I'm an engineer, and I like the idea that we're putting some maths and some actual proof and concepts behind these trades rather than just blindly putting on trades and hoping for the best. So I really like their trade. And I think I mentioned earlier, it's not a book, but it's a YouTube channel. And most traders have probably heard about Dan Sheridan at some point. He's a very good options trader. Full disclosure, again, I've never been a member of any of his things. I've just watched his free YouTube videos. I like the way he thinks about options trading. He's always, the moment he puts a trade on, he's like, this is delta neutral, positive theta, negative vega, whatever. And that's the way I think about options trading. So I like that way of thinking about the Greeks and the numbers and how that works. So I recommend Dan Sheridan, and I recommend Julia's book.
And I will, of course, also recommend to watch some of the other interviews we have done on this channel. Every Sunday, we publish a new interview with a retail option trader or an option trading expert. So I hope you will find some of interest to you. Simon, thank you very much for a very interesting presentation of your strategy. Thank you very much for joining in this interview.
No worries. Thanks for having me. It's been great.